Hello, Heart of Economy viewers. It's midnight. The markets are asleep. Gold prices are steady. Barely a flicker on the screens. And then, breaking news. The US imposes a 39% tariff on large gold bars. Within minutes, prices start to soar. $3,200, $3,300, $3,400, $3,534, the highest in gold's history. But just hours later, a cold shower. That tariff never existed. So how did a non-existent decision turn into a multi-billion-dollar gold storm? Who profited from this wave and who took a heavy hit? Let's go back to that night. August 8, 12:05 a.m. On the official website of the US Customs and Border Protection, a small, plain text appeared. At first glance, it looked ordinary, but inside it held a detail that could shake the gold market to its core. The customs code for 1 kilogram and 100-ounce gold bars had changed. The new code placed them under a 39% tariff. These large gold bars are the backbone of global gold flow, produced in Swiss refineries, stored in London, delivered through the New York COMEX contracts. If any link in this chain breaks, the global market feels it instantly. A tariff means higher costs mean reduced supply, which means a price explosion. And that's exactly what happened. Bloomberg, Reuters, CNBC, and the Financial Times all ran the announcement as breaking news. In Asia, Tokyo and Hong Kong markets were open. Algorithmic trading systems saw the word tariff and instantly switched to buy mode. Traders who were short on gold panicked as prices rose, rushing to close their positions. Those closures themselves triggered more buying. Within minutes, gold hit $3,534, an all-time high. Trading rooms glowed green on every screen. Phones rang, coffee cups emptied, and everyone was talking about one thing: the tariff is coming. In finance, there is a saying, markets move first, verify later. That night, investors followed a simple mental chain: tariff, higher costs, lower supply, price spike. Bloomberg's alert reached Reuters, MarketWatch, and the Financial Times within seconds. Social media became the accelerator. On Twitter, #gold tariffs climbed into the trending list. Finance channels on YouTube changed their live stream titles instantly. Gold hits record high. Tariff panic begins. Investor psychology works like this. If a piece of news comes from multiple trusted sources at the same time, it feels confirmed. This illusion of multiple confirmation, especially when the news has an emotional punch, can send prices flying in seconds. When algorithmic buying systems and manual trades move in the same direction, nothing stands in the way of a price surge. The result? A jump of more than $200 in just minutes. While prices were at their peak, a completely different kind of activity was unfolding behind the scenes in Washington. Risk management desks at major investment banks began to suspect something. The US doesn't announce a move like this at midnight, and there was still no official statement from the White House. Lobbyists and political advisors with inside contacts started making calls. Phones rang, emails were sent, and sources tried to confirm the story. Within hours, a White House spokesperson stepped in front of the cameras. There is no tariff decision. This was a misunderstanding. The market's reaction was like a cold shower. Prices began to tumble. $3,500, $3,450, $3,400, $3,300. Those who sold at the peak pocketed huge profits. But latecomers, especially small investors who saw the news on social media, were hit with painful losses. It provided a classic truth in markets. Sometimes, it's not facts that drive prices, it's perception. To understand this phantom tariff story, We need to revisit past events that sent shockwaves through the gold market. 1971, the Nixon shock. On August 15, 1971, U.S. President Richard Nixon unilaterally ended the dollar's convertibility into gold. This effectively marked the end of the Bretton Woods system. Gold began trading freely in the open market and quickly surged. It was a revolution in the global monetary system. 2008, global financial crisis, the collapse of Lehman Brothers and the erosion of trust in the banking system pushed investors toward gold as a safe haven. Demand skyrocketed and prices spiked in a matter of months. This surge was rooted in a real financial collapse. 2020, the pandemic, the uncertainty triggered by COVID-19, combined with aggressive interest rate cuts and money printing programs by central banks, pushed gold to break its then record high. The common thread? These surges were based on concrete, verified events. The 2025 incident was different. The only driver of the price spike was a false perception. Let's imagine for a moment, what if this tariff had actually been implemented? Short term, gold could have jumped to $3,700 or even $4,000. Physical gold imports into the US would have plunged. The gap between spot and futures prices could have hit historic records. Medium term, delivery systems on a New York COMEX might have jammed. Traders would demand physical gold instead of contracts, making the situation even tighter. Confidence in futures contracts could have eroded. Long-term, U.S.-Swiss trade relations would have suffered. Swiss refineries might have pulled out of the U.S. market, shifting focus to Dubai and Singapore. Central banks might have shifted from holding U.S. dollars to holding more gold reserves. The center of gravity in global gold trade could have shifted from west to east, but the impact would not stop there. Earlier this week on Heart of Economy, we explored in depth how a single custom ruling could reshape not only the gold market but the global financial order. In that episode, we discussed how such a tariff could disrupt London bullion banking and COMEX delivery flows, trigger a dehypothecation wave, pulling pledged gold out of the system, undermine confidence in paper gold and force markets toward physical delivery, weaken Switzerland's refining dominance while centralizing price power in New York, potentially allow the U.S. Treasury to revalue its gold reserves, unlocking over $1 trillion in balance sheet gains without issuing new debt, and, perhaps most importantly, raise the unsettling question, is all the gold really there? If these dynamics were set in motion, the effects would go far beyond a short-term price spike. We would be looking at a fundamental reordering of the gold market's geography, the credit system's collateral structure, and even the geopolitical balance of monetary power. This incident gave us a critical, clear message. Markets are fragile more than ever. The US's massive debt load, high interest rate policy, inflation pressures, geopolitical tensions, any of this could trigger a move in gold. From now on, expect to see more frequent and sharper news-driven price swings. Gold testing the $4,000 level, perception manipulations becoming more organized and targeted. Imagine one night, a rumor spreads on social media, China has started selling US treasuries. True or false, no one knows yet, but the markets won't wait, they'll move instantly. That's the reality of this new era. Speed has overtaken verification. For investors, the lesson is clear. Be fast, but don't be blind. Verification as your best portfolio defense. Johnny Tefts, UBS strategist. Events like this cast doubt in the reliability of the US gold futures market. Investor confidence can be badly damaged by unverified news. Had this false story circulated longer, the price move could have been even more extreme. Peter Schiff, Euro Pacific Capital. False or exaggerated news can trigger massive short squeezes in markets like COMEX, pushing prices far beyond real supply-demand dynamics. In these situations, small investors almost always take the biggest hit. Hans-Georg Bach, Swiss economist: "If the tariff had been real, Switzerland's gold exports to the US could have lost billions of francs annually. The sector could have faced between 7,500 and 15,000 job losses. This wouldn't just be a financial issue, it was also a matter of employment and trade balance." Today we saw how even non-existent tariff can create a real storm in the financial world. Gold prices shot up to $3,534 in minutes, then fell just as quickly. The winners were those who got the news in seconds and acted fast. The losers were late entry small investors who trusted unverified social media posts. This story leaves us with the three crucial lessons. Perception can outrun reality. Markets react instantly even to unconfirmed news. Speed is good, but verification is essential. Remember, it's not just humans trading anymore. Algorithms can place millions of dollars in orders within seconds. And in this world, misinformation is more dangerous than ever. If you don't want to miss depth analysis, market stories, and future scenarios like this, subscribe to Heart of Economy. Like the video and share your thoughts about this event in the comments. This is not just an economics channel. This is where the heart of finance beats. See you in the next video.